Investors looking to shrug off a mixed news week headlined by cooling inflation and the Federal Reserve pullback on interest rate cuts. Let's dive right into what's been moving the markets here with Megan Horneman, the CIO at Verdence Capital Advisors. Megan, it is good to see you. So, let's start there, Megan, with the Fed. I'm interested to get your take. Of course, we heard from Jay Powell yesterday, and they signaled one cut for 2024, Megan. Did that surprise you?
No, actually, that's been our view all along, that there's been way too many rate cuts priced into the market. It did surprise me a little bit that he did come out and delivered kind of a hawkish tone in that meeting, because he's been dovish in the past few meetings. And our concern is that it's been fueling this optimism around rate cuts for this year. We came into this year thinking it would be a second half of the year story, not a March story like most people did. And right now we're still thinking that the Fed is probably needs, as they said yesterday, they need more consistent data that's showing that inflation is officially behind us.
Megan, even though you read his comments as more hawkish, and a lot of folks did, at the same time, the market didn't seem to either not read them as hawkish or not react to them as though they were hawkish. What do you make of that?
Unfortunately, I think the market is seeing what it wants to see, and they want rate cuts. And that's what we're seeing in the bond market, we're seeing in the equity market. I mean, the rally we've seen in bonds is telling you that. They want these rate cuts, and investors want to see rates come lower. But I think that it's a little, I'm afraid that the market's getting a little complacent around what we can see in the second half of this year and what they have the ability to do from a rate cutting perspective.
Also, Megan, just in the near term here, what do you see as potential catalysts ahead for this market, Megan? Actually, Fed Day is now come and gone. Earnings are in the rearview mirror. Near term, what do you see?
I don't see really what any potential upside catalysts are, and that's the problem. That's why we're a little cautious here on the market. I see more catalysts to the downside. You can see from a political standpoint what's going on over in Europe right now. Let's not forget we have a presidential election coming up. The valuations in the market are a bit frothy. We've gotten 1 month of good inflation data, but we still have a long way to go before we can say that that's behind us and the Fed can start a rate cutting cycle.
And so given that, if you're more cautious in the market, sort of how are you expressing that?
We have an overweight cash right now. We're not overweight these tech-heavy growth names or even the sectors. We look within value in the market, but we are an overweight cash in our overall allocation so that we can take advantage of opportunities, because it's been a long time since we've had a correction in this market. We had, you could say, modest pullback this year, but we think we could be in for a correction in the second half of this year.
So if there was a correction there, Megan, and you wanted to put money to work, where would you be looking? Where would you be opportunistic?
Honestly, if you look at the small and mid cap space, that area hasn't really participated as much in this rally. I'd like the opportunity to put some money to work in that space, but that's also very cyclical and it can be interest rate sensitive. So we're cautious there, but that's where we will look at the pullback, at the correction. Is it pricing in all of those risks that we may see from an economic standpoint going forward? So we like that side of the market. We think that's been the most unloved area.
Do you think that rates need to get cut in order for that to really pay off?
Typically, that's when the Fed has to come in and cut rates. That's because the economy is doing worse. You want to be able to get. That's when those small and mid cap stocks. That's when they tend to get hurt. But on the way out of it, out of the recession or out of the economic downturn, they're also the ones that rally the most. So we're okay being a little bit early to it if the valuations are pricing in that downside risk, because they will rally the most coming out of it.
Megan, thanks so much. Good to see you.
Thank you.